I have so much better music than that. I would love to play it as an intro. But yeah, it's a good addition to Twitter to have this music. But I think the choices are somewhat limited. So welcome back, everybody. A lot to talk about. A lot of stuff going on on Twitter and podcasts. A lot of discussions, debates, arguments. Too much for me to keep track of, honestly. Last night I was very prolific at the Lightning game. Very disappointing hockey game, but yeah, I missed quite a bit of it because I was on my phone too much, twittering and drinking. Not a good combination. And I stayed up way too late. And I was hunting tweets last night and commenting. Not a good idea. So a lot of those things to talk about. The markets. How many markets is enough? Outliers. 5% of the trades are outliers. Very confusing. A lot of different opinions, a lot of good things to talk about. Um, and then I am going to be on a podcast at 4 p.m. Eastern time today, which, these guys are going to give me the business. They're tough. They're the best. They know their stuff. And I'm walking into a lion's den. I got to be careful, keep my emotions down. So anyways, resolve riffs at 4 o'clock. I'm not sure I should be doing this. Too late to back out, and I would never back out because obviously I'm going to enjoy it, and I have high expectations for myself. Um, 39 years of trading. It'll be 40 in the fall. So yeah, it's a long, long time. I've heard it all, and I should have my philosophy down and my arguments ready. Okay, get ready. I want to hear what everybody wants to talk about. Oleg, are you ready?
Yes, I'm ready. Hi, Jerry. Hi, Richard. Hi, Bruno. Hi, Andrew, Alp, and Jerry Smith, of course, and all the guys I see here. Michael Harris. Great, guys. So, I am saying traditionally the same things in the every starting of our trend following trading ideologies that I'm very happy that I was waiting for a whole week, and it's really so. And I say this only because it's a truth, and it is from the bottom of my heart. Because I'm a happy person. I have said this before because I have something I love, and I'm very happy because of this. So, this is our trade following ideologies are starting. I was thinking a lot about how many Jerry said just before, how many markets are enough in diversification. And I think that I agree with Jerry and Richard here now, right now, that there isn't such thing that then over diversification, then too much markets. I think if you have amount of money that gives you an opportunity to have a very wide diversification, maximum diversification, it's the best thing. I think so. And of course, if you don't have, you must do something to be diversified as possible, maybe so. And of course, if we are talking about short-term trading, of course, I have said before that maybe the main bonus of short-term trading and that you can be less diversified. The main bonus. And the second bonus that investors, when they see drawdowns from the high, they simply don't understand us. They think that we are losing money, and in short-term trading, we know that statistically we have lower results, less performance strategies, but investors don't understand this. They think that it's very good, that it's not so much drawdown from the highs. But I think that first of all, we must think about our performance, about our philosophy, and not about investors' philosophy. It's my point. So here is my points.
G'day, Oleg. G'day, Jerry. Hi, everyone. Yep, looking forward to tonight. There was, a lot of debate going on in Twitter this week. Gets quite exhausting after a while, but I'm looking forward to tonight and hearing what people want to talk about.
Hi guys, hi everyone else. Hey Jerry, hey Richard, hi Oleg. Hi guys. So, you know, yeah, I was this week I was thinking a lot about the outliers, and I don't know why, but outlier is very, short and sweet. It's easy to say, so it just sticks around, I guess. But for me, outlier is a super performance trait. So when we say outliers, actually we meant to say we are we are trading super performance trades. So it is important to mention that. And any trader who would like to make money would want to associate himself or herself with these super performance trades. And in my systems, I'm able to capture 5% of those. So this means that 95% of the trades basically cancel itself out, and the remaining 5% is where I'm making money from these super performance trades, which are usually 3R multiples and more. So it's very actually interesting. And when we talk about these managed features, so these guys do not want to capture these super performance trades. They want to capture good performing trades, but not super performing trades. And possibly these guys would like to capture not 5%, but more than 5%. It's like a volume business. So it's not so it's a different philosophy, but for me, capturing the super performance trades is no brainer. So that's why I prefer that. Thanks a lot.
Now, yeah, that's all very interesting. And I can't. I really, don't usually agree too much with the what. Well, I don't agree with everything, or maybe 50% of what I hear on Top Traders Unplugged. And when Richard's on there, that's up in the 90s. And but I will say that I really have enjoyed the Top Traders Unplugged or Systematic Investors, whatever it's called, the CTA series, interviewing the CTAs that make up the SocGen CTA index, and Andrew Beer, who replicates that. I love Andrew, as you all know. So I think that there's some really good stuff in there. I highly recommend you to listen to it. Not stuff that I necessarily agree with. I just think it's interesting, and they say slightly different things, and I feel superior sometimes after listening to them. I'm joking. Okay, so I did think though that one of the things I thought was very interesting was the gentleman from Graham. I like that one a lot. I tweeted it a lot. You can go back and listen, or you can just read my tweets and listen to the clips I put out there. But whenever I go back and listen, I learn a little bit more or hear a little bit more. I'm not sure if I'm learning too much. But anyways, my contention has been for quite a while, and no one calls me out on it because I just make shit up and no one really. I mean, it's probably true, but some of the stuff I make up or I just guess about, I expect more pushback. The stuff I know to be true, I get a hell of a lot of pushback on that. Okay, so one of the things I've said over the years is I don't really think the bottom line to this volatility and correlation management is risk. Oh, yeah. Oh, they talk about it. Oh, elevated risk. Do you want to keep this on as risk? And then this guy gets into some nonsense that because we don't vol manage, we are predicting that our trend is going to continue to work. It's going to be a fruitful period for our system. I couldn't even tweet that because it was so convoluted. And so he's like, I can't predict what's going to happen in the markets, so I vol manage. Super smart guy, super duper smart guy, but this was nonsense. But one of the funny things about it is he steps into it when he says, vol management in 2022 was very beneficial for CTAs. It acted like a take profit. This is what I've been saying. It's just a low-class way of taking profits, and then they sell it as risk control, risk management. And people who use stop losses as their primary way of risk control, as a primary way of risk control, we have other ways, of course, miss the whole boat because of not bowing down to the gods of smoothness and correlation and sharp. And so I just found like that was a really funny thing for him to say, because that's exactly what it is. It's just taking profits off the table with bogus rules based upon the size of these profits, and these size of these profits can be really large. And of course, there's very low sample size for exiting the trade with a large profit. So I just think that was very funny to listen to, and I really enjoyed though tweeting more from him. And I just noticed too that there's people in the spaces today who send me kind of rude responses, and the hostility that we get from people over not wanting to vol manage and correlation manage, I find just interesting and telling, because we really have hit a nerve, and we're not going to toe the line of using normal ways of measuring risk, the usual ways of measuring risk, the usual ways of looking at the portfolio and the smoothness, and we're going to get shot at, which is fine. But back in the day, I was more of a listener and a learner than a bitcher, and listening to the crap and reading some of the crap that's written out there.
Hey, everybody. So I've been doing a little bit of research recently on filtering out short trades that have a limited profit potential. And I kind of wanted to get everyone's opinion on doing that. Is that curve fitting, or is it just trying to eliminate bad trades before they happen?
Yeah, I mean, I've been doing this for years, and I like it. And if you are looking at the markets like on a trade by trade basis, which is what I do, look at every trade as if no other trade exists. I have an entry, I have an exit, I have a stop loss, and I'm very concerned. I'm not letting anything in the portfolio or any other trades influence that position. It's just going to hold it the whole time and wait for that trend following trailing stop to get me out, or the stop loss. And so I think if you're looking at these trades like that, you're going to be very concerned with your average trade, the expectation per trade, and you want that thing to be juicy. And you want to bet one and win two or three. And so it's normal for me, and I really like it. But I have had very bad relative performance a few times by using it. 2008, and then I think 2020, the fall of 2020, when crude went to negative, that period, there was a lot of good short trades. Now in the following quarter, I made it all back, and I didn't lose, because none of those shorts did very much, and some of them turned into losers. So I really like that idea. I've always wondered why other people didn't do that, like the bigger CTAs, because I would read articles about so-and-so being short natural gas, and the potential profit in that was like 5 or 10 ATRs, which, hell, my stop loss can be that amount. So I just wondered about that, but I think it gets back to that they don't look at things on a trade by trade basis. I think they look at the portfolio, and the portfolio is this soup of markets, and they're increasing positions, decreasing positions. So if at the entry you don't have a lot of potential profit, maybe you can increase that position as correlations get lower, and the vol gets lower the whole way down, and maybe you always have this potential to go ahead and put it on when doesn't look that favorable, but then things can change along the way. And so for me, the trades never change along the way. I don't really think it's curve fitting. I think it's not handling every trade the same way, which is a strict rule of mine. So obviously I'm violating that. Yeah, I guess I am treating them the same way because I'm applying that metric to every trade, every short trade. Yeah, so I think it's fine. I apply it to every single market. It's more prevalent in when you short equities, but it can happen in commodities. So in the commodities recently, all across the board, wheat, corn, beans, oats, rapeseed, rough rice, palm oil, go down the list of all those grains. They hit the break. A lot of them hit the downside breakouts months ago. I never did them. Now the ATRs have shrunk so much, and they're still pretty close to their lows or original breakouts, that now they're valid trades for me. And now I'm going to put on a nice position. So yeah, I like this idea. I've done it forever. I'm not going to back off of it. Just get ready for material relative underperformance for a few months, but you'll probably get it back when those trades don't really do very much. What have you found so far, Seth?
Well, I guess I sort of programmed that rule and then step tested it over a number of ATR multiples, and around using a threshold of around 100, it returned the best results, and it made a huge difference over a 40-year test in improving, the compounded growth and reducing the drawdown. And I think, which most people seem to not focus on, reducing the drawdown length. I mean, it lessened the average drawdown by like a year or something like that. But the thing I kind of struggle with mentally about it is, do you really want to apply that kind of rule to currency trades, since they're more relative um, than like a fixed thing like a commodity or an equity is? But I guess that the ATR probably takes care of that, where you're not ever going to see the ATR be big enough to limit that trade. But I think it makes a lot of sense with commodities. But then you see like what happened to oil. Does that could a potential outlier that makes your year, your decade, come with a negative price like oil? That's what's kind of in the back of my mind when I test that.
Yeah, well, none of us could have really gotten that negative price because we would have had to move on to the next month. And then if you got out in a trend following way, you gave back so much of that negative price move. I've not been as aggressive as 100, and I don't think you need to. I think it's robuster, more robust, if you apply it to all the markets in your code and watch it not ever come into play on anything other than commodities and stocks, single stocks, and it'll come into play with with indices as well. I asked Barchart and they to write me a study or something you could put on the screen and on your watch list that calculates the price divided by ATR. They just put it out there recently, so you can thank me for that. I think. Oh yeah, another thing. I tested it on stocks, and I tested it on all the markets, and we came in with a number that's. I'm sure it gets better and better. 100, in that range is probably better than what I did. We just found a sweet spot where we didn't want to eliminate too many shorts. We wanted to get rid of the really, really bad ones, but we didn't want to get rid of too many of them because they're kind of like a short-term system for us where we would probably lose money, but it would help with diversification. So to some degree, a lot of the shorts, they don't make very much, but they kind of help out sometimes. So it's our sacrifice. And we don't want to trade systems and negative skew stuff that really has bad characteristics and really is not going to, and it's going to help us during periods when trend doesn't do so well. We don't like to make less money. So we say, okay, we'll do these shorts. We won't go as high as 100, but we'll implement this thing anyways. Now, one thing to remember, though, is when you measure that at the breakout, when you first do the trade, you have to remember that when that trade is over, or throughout that trade, you may have calculated that this trade had 100 ATRs of possible profit when you first put it on. But the months and months later, that number will change. It will change because of spreading. And so it's not like a cash market that it's not going to change, but you will be slightly off a bit. And so it can sort of rehabilitate itself. If you don't do the trade, because it's at 99, it can sort of pop up to over 100 later as you spread that market. So it's not a perfect measurement, but I like it. I think it's a great idea. I have some other things that I do that are way worse than that from a strict trend following, robust point of view. But we got to make compromises.
So if this is all right, I do have a question to Jerry Parker. Jerry, while trading the stocks, while we are trading the commodities, they are raw commodities like coffee. So we trade raw coffee or raw beans. But when we trade companies, actually who process those things, so companies who process coffee, the companies who process precious metals or beans or energy, do we allocate the risk with the same commodity risk? Because these companies are still processing mainly commodities, or do you tend to give the risk allocation from stocks? I'm asking this because it's genuinely different. A company who processes coffee or cannabis or beans or precious metals is quite different than Apple or Microsoft. Thanks.
I agree. It's quite different, and it's different enough to trade for sure. It's not the same. So you're getting some diversification there. I mean, if I'm willing to trade Brent and WTI crude and sort of say, well, they are correlated, one can have a huge move, and while the other kind of sits there, well, then certainly the same thing can happen with these companies that derive all of their income from eggs or French fries or lumber and shipping. And so I put them in the stock category, but I don't really pay that much attention to categories anyways, So I'm not limiting my risk per sector, per category, 25% each in currencies, commodities, stocks, and bonds. I'm kind of treating every market differently. And I've got a lot of diversification, but I really don't try to fine tune it very much or at all, right? And I've noticed that, when I was long lumber, I made a lot of money in that lumber move. And then the lumber companies, they had different P&L and different chart patterns. And when lumber kind of collapsed, some of the lumber companies, they kept going. Same with shipping futures. And I follow the shipping futures, and they collapsed as well. And then some of the shipping companies, they really kept going. And they just had different breakouts and different patterns, along with all the shipping companies. They don't really look that similar, especially when you overlay it with trend following of the companies and sectors. They can look a lot different. But I do think that overall, I would rather trade the raw commodity than the stock, honestly. I don't know why. It's probably just a bias, but I think all the CTAs who shake their head when I talk about stocks incessantly, I do it. I have to trade these stocks out of necessity and not because I prefer to. I mean, kind of grew up on futures and commodities, and I'd rather trade. but there is no egg futures that I can trade. Or in the way to get massively more diversification is to spend a lot of time finding companies that that are different and that are that can give you this type of diversification. So, but I kind of like I cherry pick my markets, and so I don't. I am going to put a limit on the amount of stocks I trade because there's a lot of stocks. I could trade all stocks, 90% stocks. So I can trade all the currencies, all the commodities, all the interest rates, and it's really going to be about 50 or 60 of each. And then I can just go out and decide how many stocks I want to trade, 60 or 120, and that's what I've done. So I, for the classic trend following that, that Richard and I talk about, we, in the back of our mind, are concerned about getting overweighted in any one sector. But once it's on the trade sheet and we're ready to go with it, we treat them all as if they're individual markets ready to do their own thing, because they're all going to have an outlier one of these days, and it may occur when none of the members of their group has an outlier. I've participated in those trades over the years. Silver, heating oil, crude, yen, it can happen. And then I think I don't really see a diminution of performance on the kind of normal trades. Targeting the outliers, you're still going to target and pick up a lot of the normal trades. We're just not going to, when the yen gets going or the pound gets going and it looks like, well, in this big currency move, big dollar move, it looks like we might have two crazy ones like the yen and the pound. So if the managed futures CTAs see this craziness happen, they're going to cut it back to make it more normal. I want it to look like the yen. This abnormal trade with this abnormal P&L in this high volatility, it is making me very nervous. I need to manage this. It's a problem. It's anti-smoothness. But of course we embrace that. And I honestly think at the end of the day, there wasn't anything in that currency move and not very much in that interest rate move. It was just a bunch of markets all correlated, moving at the same time. And we made money, and just like everyone else did. And then but whenever there is going to be something crazy going on, the mere fact that we're going to give it loose pants and not cut it back if the correlation spikes up and the vol spikes up, that's how we're going to facilitate capturing these outliers. I think hunting them is easy. Finding them is very easy. I've been hunting, and sometimes you do not find these what you're after. Much less if you do see one or two, you could miss it. But we never miss it. We find them and we never miss them because we have systems that don't miss. It's not nothing to brag about. It's easy to not miss a trend. That's why we have 60-some% losing trades, because we're frequently overwhelmingly wrong. When we put a trade on, it's going to lose most of the time. The key is hanging on to it, not getting freaked and hang on to it. And then capturing that profit, having your trend following exit do a good job getting out of the profit. And that doesn't always happen. You can sit with a trade for a year or two and give most of it back in a week. So that does happen. It's just one of those things.
Thanks, Jerry. I mean, when you're talking about the single name stocks trading, as far as I understand, we are already out of the scope of classic trend following, because classic trend following hasn't started with trading single name stocks. And at the moment, I'm backtesting these single name stocks, and there are so many additional considerations that I ended up thinking about, which hasn't been covered with the classic approach. It's much easier to, in my humble opinion, to trade indices, but with the single name stocks. So, for instance, one of the key determination is how much risk you're going to allocate among equities, credit, commodities, and forex? Is it that does it make sense just to allocate 25% to equities, or is the better approach to go and allocate 50%? So one question. The second question is, in the bull markets, these equities are making much more money than anything else. Like it's not only 2009 and 2010, which are obvious 2 years, right? But when you go to 2003 to 2007, when you go back 1995 to 2000, you always see these huge bull markets where stocks are making a lot of money. So changing the allocation from 50-50 to 60-40, 60 stocks and 40 the rest of it, even makes a huge difference. Or, or if you're going to be conservative, you may want to allocate 25% to equities, but then you would still think that when the bull market happens, you might be just better off to increase that a little bit. So the question becomes, are you going to keep your allocations fixed, or you want to have dynamic allocations? Because during the bull markets there's a long bias. So that's my observation. I'm not quite sure whether Jerry or the other participants would agree on. Thank you.
Well, I think that I think you were saying earlier that stocks. It's you have a lot of noise in the background, but I think you were saying that the stocks are not part of classic trend following or something. But I think that when you're going to treat all these markets the same with the same system, you're going to have the same rules. And my stock answer over the years has been continue to ask yourself if you're going to trade these stocks or trade crypto, for instance, things you've never traded before, not part of any back test because they just, you just started it, or most people don't trade stocks, and then crypto futures, I trade crypto futures, they just started. So ask yourself, you really want to force yourself to handle all these things the same way. When you add a commodity, there's no anxiety there of, well, what should I do? How should I do this? You throw that thing in your portfolio, you use the same rules, the same risk, unit size, and you're off and running. You're an instant expert because you're just buying and selling breakouts. And in the same way, having never traded stocks before, with trend following, you're an instant expert. You know exactly what to do. You're going to trade all these markets the same way. And so I don't really understand why you wouldn't. And I think then always you want to have this fixed allocation, and a fixed portfolio to the best of your ability. Some markets go away, some stocks get bought out. You find other markets to increase your diversification that you want to add. That's fine. I just think, and you can kick markets out. You're just totally not down with something about a market. I would kick it out for liquidity reasons, but that's about it. As long as it's still liquid, I would just keep it in there. And so you want to have a fixed portfolio, a fixed allocation. You're betting, and you want to do the bets all the time. You don't want to give up and change things, kick a market out, add it back in, have this extra overlay of when to trade certain markets. That's not going to work for you. And I think you want to allocate to each of these sectors. I don't like opining on stocks because we're going to treat all these markets with the same logical way. So with all of the sectors, we're going to essentially weight them to the degree that they add to our diversification. So, if you have a great diverse group of equities, and some of them are long and some of them are short, and you have done your research, and the back test is indicating that yes, they're technically all in stocks, they're in the stock sector for me, but they really are giving me as much diversification or more than the currencies or the bonds or the commodities, then you can I add more. So I effectively overweight stocks because they deserve it. More stocks reduces my volatility and risk, and less stocks would make the portfolio. Now, there are going to be times where all the stocks go down. That's why you want to have a group of equities that are very different, that offer a lot of diversification. So you're going to have some shorts on. Now, in my example always is the same, 2020, where everything went down, currencies, commodities, stocks, and bonds. So there was no diversification anywhere. And I think I was long like everything. So we got crushed. So yes, stocks crashed, but so did currencies and commodities. So you can't confuse that decision with something that can happen with any market. And in 2022, we had a much different situation where all the bonds went down, no diversification, but we made money. So we're happy with that. All the currencies went down, dollar strength, no diversification there. We loved it, made so much money. Commodities had a big run up 2020, 2021, loved it, no diversification, no shorts. Stocks, I've had longs and shorts. You can find many longs, many shorts for the past year or so. So they're offering, it's the only place for diversification until recently when I was able to go long a few interest rates and long a few currencies that are turning into losing trades. So the best laid plans are always going to be interrupted by crazy things happening. That's why in your back pocket, you always have the cutback rule that when all hell breaks loose, I'm long everything and everything is going down. You can reduce your positions across the board to live to play another day.
Al, but the way I'd treat the problem would be like this. So what I'd say is, let's say that theoretically you could test 1,000 different return streams from 1,000 different markets. So the way I'd do it is the first thing I'd do is I'd say it's just data. I wouldn't care about what type of data it was, whether it was a commodity, whether it was a stock, whether it was an index or whatever. I'd just have 1,000 return streams to evaluate. And then I'd say, now, realistically, the maximum portfolio I can afford with the smallest bet size and maximum diversification might be 300 markets. So what I'd then do is I'd test all of those 1,000 different markets as possible ensemble combinations of 300. In other words, iterate through this immense number of iterations for 300 markets within that total context of 1,000 to determine what is the optimal portfolio result. Then examine what are the stocks, what are the markets that are represented by that ensemble of 300, because there's nothing worse than relying on a cliche such as all stocks are super correlated or all this or all that. You hear it all the time. Rigorously test the assumption using long-term data sets, and also make sure that your models have multi-market capability. In other words, they can trade all of those markets in the 300 final selection. If that is the case, and they can trade all of the 300 markets, your trend following models, you know they're robust because they're not curve fit or over optimized for a single market. They're applicable across all of your 300 markets. And then see what your universe actually comprises, the 300 out of that 1,000 possible selection. You might be surprised, and you might find that there are numerous stocks sitting in there with a 20-year history or whatever. So clearly the key requirements you'd need for an evaluation like that is a long-term data set. So you need stocks with a long history. So that's eliminating a lot of the shorter term sort of stocks. I know that's a problematic problem for the process, but I think with the huge possible combinations you could choose, I think having sufficient data, making sure they're liquid, these are the key criteria that must be for each of those data sets that you use. But don't look at the names associated with them, because I think, from what we hear on Twitter and all of their sort of, the gospels that are around, they sort of seem to say keep away from this because it's a highly correlated sector or a segment, and diversify just in commodities. I think these are things you want to test with your testing processes.
Yes, I can agree more. That was very well said. I agree with all of that. I think that, basically not trading single stocks during a period where single stocks would fit really nicely into our strategy with, and there were lots of outliers. And it was the only game in town. It was the only trends going. And we kind of, as a managed futures, kind of didn't avail themselves of that ability. So they have a lost decade. They have a lost decade because they didn't make money that was staring them right in the face, trading the markets that they could have traded. And they're going to have another lost decade or another lost 5-year period whenever you eliminate essentially a sector of, you eliminate a sector of markets. Don't trade the currencies trade the dollar index only and see how that works. It's not going to work very well. Trade the bond, the 30-year bond only, and see how that works. So not having sufficient allocation to a sector that warrants it is from purely a diversification point of view. I never said anything about performance. I'm not going to allocate and portfolio weightings to markets based upon historical performance. I'm going to do it based upon the risk reduction it brings to the portfolio. I'm going to max out that risk reduction. So I think, and at some point in time, clients will, maybe after I'm gone, but clients will realize, CTAs will realize that selling the trend following of the stocks in the portfolio, a material amount of single stocks in the portfolio is really the best crisis alpha, because allocating a small amount to CTAs in the portfolio is not going to have nearly the impact of trend following those stocks. Liquidate some of your buy and hold equities, put it into a fund that has material positions in single names, let those stocks be trend followed, and combined with great diversification in currencies, commodities, and bonds, and short stocks as well. So that is why it's kind of, in my opinion, kind of the perfect portfolio. Is just now being sold as a small allocation crisis alpha for long only stock and bond portfolios. But CTAs need to protect themselves and their companies and their business and their track records and trade as many of these markets as possible, irrespective, and with the proper length of the system as well. They're sort of argued sometimes in some spaces where we've talked about this, where they'll argue that sacrifice your performance and trade shorter term because you'll get short the S&P quicker, and you'll add crisis alpha to the other guy's portfolio, even though overall it's going to make your performance worse. This is like some strange Stockholm syndrome where our captors, we're sympathetic to the people who are enslaving us.
You kind of said it's okay to cherry pick markets as long as you use your rules of your system to trade the market from then on. When it comes to stocks, you mentioned eggs too. Do you kind of hear about macro trends that you think might be emerging, like an egg shortage, and then go try to find an egg equity that is then liquid enough and then has a trend in place and then jump in it? Or do you look at every egg company, anything that's egg related, and then put it in your market universe and then wait on a signal to come?
So I think, when you're setting up your portfolio, I don't know if cherry picking is the right word, but you're doing something kind of discretionary. You're trying to build a portfolio of a lot of diversification. So whether you're a typical CTA that just ipso facto accepts whatever the CME and ICE put out there, I'm going to trade those markets. They're futures. I'm going to trade them. They're liquid. Which ones? All of them. The most liquid 50 or 60 or whatever. I'm going to trade them all, and that's how I'm going to choose. Well, That's fine. That's not much fun, but you can just continue adding whatever the futures exchanges give you. But you're going to have to make these discretionary calls. And I'm just saying the discretion I use is liquidity and diversification. And maybe sometimes it could be even common sense diversification. But then I'm not even going to pay that much attention to diversification because I'm hunting outliers primarily, and I'm going to trade crude and WTI. So, okay. And so I am always reading these articles and doing research on, so recently, 3D printing. And I'm like, oh crap, 3D printing. I don't have a 3D printer in my portfolio. So I go out, I look at what's out there, I do my research, I look at liquidity, I read what's going on in these companies and try to find something more unique, small company, with more concentrated bet, with one line of business, let's say. And it's on the, I choose one or two and I'm going to trade them. Hopefully they never come off my trade list. But I'm not sort of saying, hey, I've heard about this macro egg trend or a 3D printer trend, so I want to get on this. That would not be my motivation. It's strictly like, because some of the markets that I add, I read about the sector that they're in, and I realize, oh, that's interesting. I don't have that coverage. I think this can turn into an outlier. It could be a shortage. There could be oversupply, and I could have a really good long or short outlier on this. And they're in a downtrend, and I'm not even doing the trade. It's not even going to be a trade for me for a long time, but I'm going to add it anyways because I want to give it a place, and I want to get ready for the next big trade. So I'm not going to do anything really other than the diversification thing once again, just like when I add commodities or currencies. I mean, I'll add any currency. I trade so many currencies, cross rates and currencies versus the dollar. Not even a question. It just gets on there. There's not that many. It's not going to overweight my portfolio to too many currencies. It's the stocks I have to be careful with. There's too many to choose from. There's too many interesting ones. And thankfully, they're doing their own thing. And especially with equities, and all over, as Richard taught us a long time ago, a lot of the benefit of trading all of these markets is the small bet size. Because even when markets are correlated or not correlated, they will have these extreme moves against you. And I'm so thankful in some of these days where I look at what's going on in some of these stocks that I'm so glad I have such a small position because they can really have some monster sell-offs, I guess due to earnings or whatever. But
yeah. Hey, Jerry. So regarding the stocks, so as you explained, you now have 150 futures and around 150 stocks, which is, I guess, 50% of risk allocated to equities. So I have a question. Have you thought about okay. So have you run into a problem where, since margin for stocks is much lower than margin for futures, where if you have too many stocks positions, you may actually running into a problem where you're using up 100% or close to 100% of your margin, so for your futures? So let's say if you're not trading equities, you're using up, let's say, I don't know, between 20 and 30% of your margin to have your full portfolio. But then does that mean if you have 70% in stocks, the other 70%, if that gets used for cash for stocks, and then the other 30% for futures, then you're using up close to 100% of your margin. So have you done any calculations as to how many stocks maximally can you trade? So let's say 150 now, but let's say if you trade 300 or 400, and all of this with the same risk as the rest of your portfolio, then you're going to run into a problem where you're just going to hit 100% of your margin.
yeah, that's an issue for sure. IB, I can get 6-to-1 leverage, and it's kind of this portfolio margining. So they take into consideration all of your positions. One of the things that I keep saying, so there's something to this, and that is shorts. So your shorts are going to reduce your margin for your longs. That's good. I trade small. I trade really small. My overall risk budget is not pushing it. Yeah, I'm trading each individual market small, and if I have a position on in every market, it's on the small side. I didn't make 50, 60% last year. I've made about 20% 3 years in a row. And so these were amazing markets and the best markets I've seen in probably my career, but I've made more money, but I used to trade a lot larger. But I think the typical 10 to 1 leverage that you get in the futures markets, you only get 6 to 1. I can get 6 to 1 in stocks, but that is not quite as much. But if I think that in kind of a crude way, if you're running into these issues, you may want to consider you're trading too large. Okay. But I'll tell you a scary thing, and I've seen this happen to me, is to size your positions. And in stocks, I don't know, for some reason it's scarier in stocks. One of the problems with trading stocks is we know too much about them. We think we do. We don't know a damn thing about commodities. I don't know anything about currencies either. But with stocks, we're trying to do the same thing with stocks we do with all the markets. They're no different. We're forcing them into our CTA world, not the other way around. We refuse to abide by any of the things that everybody else thinks is important with equities. They're nothing except another market for me to take advantage of, just like I do currencies and commodities and interest rates. But I have to admit that I do get impacted when I size based on ATR, and then I total up my notional exposure. Yeah, that can get kind of out of control. So it can be way more than 2x. So my notional exposure can be very large with these equities because I've sized them on ATR, which is what I do with every trade. So I don't freak out about the currencies or the bonds, but I do look at those and go, whoa, that just sounds very aggressive, even though I'm not trading too large from a unit size, total money management unit size ATR approach. From a real world approach, I've got on a lot of notional exposure. Probably it exceeds my whole AUM or equals my AUM, the 50% allocation equal or exceeds my entire AUM. Yeah. What do you think?
Yeah, that makes sense. I actually haven't checked how much margin my broker will allow me for stocks because I don't trade stocks, but 6 to 1 is great. I thought it was going to be 1 to 1 or 2 to 1. So with 6 to 1, then you're pretty close to future.
Oh, did I answer your question sufficiently, Seth?
I don't know if anyone else is having hearing issues, but I couldn't hear absolute until I left and came back. So if anybody else is hearing blanks, maybe try that.
Yeah, I've been having problems. I don't know if it's my side or it's the Twitter or other people's side, but I've been having a lot of hearing and talking problems with this session.
Hey, George, do you have anything you want to add? You want to wade into this discussion? Feel free.
I kind of tuned in late, so good stuff to add at the moment. But if anybody wants to let me know.
I thought another podcast I enjoyed was Cliff Asness, and that was The Economist. Yeah, I really enjoy listening to him. He's such a good guy, smart guy, and funny guy. A guy that I really feel like, I don't want to. You got to be ready. If you're going to disagree with Cliff, you better be ready. And I'm not ready. I'm not ready for that. No. He loves diversification. I tweeted that. And he also said a great thing, which we don't really talk about a great deal. What drives long-term success? And he says, I would have said how smart I am, but it's 50% of it is sticking to what you're doing when it's tough. And I think that's so true. And that was certainly how I was mentored, sticking to the system. When the system fails on a trade or doesn't do well on a trade, or you're afraid it's not going to do well on a trade, that's one way. And then sticking to the system when you've had a drawdown and you haven't had profits in a while. And it's very difficult to figure out when you should not stick to it anymore. But I think we're pretty quick as a species to be worried the other way, that we're sticking with it too long. So we're probably not sticking with it too long. But I think another thing that happens is when we're unhappy with the system is we add rules to it. I need to get the unhappiness out. I think this is my big complaint is, what does it mean to follow? What does it mean to follow something? We're following these trends, and then we're following our system, and you are putting your fate in something else. And you're going to follow it, not yourself, but this other thing, this person, this strategy, this philosophy. And what do you expect it to be like? Just like I would do it. No, you don't. No, because that's not the case. You've abdicated to something else, and you're going to follow something else. And so it's going to be the road, a road less traveled. It's going to be difficult. It's going to be pain and suffering, possibly, because you're taking the long view, and the view is it's going to work out in the end if I delay gratification and sacrifice. And in following it's going to have a certain amount of fear to it. Do I have a safety net? I don't know. It's always kind of worked out in the past, but I don't know. Is it going to work out in the future? So I think when we ask ourselves these questions about wanting to follow, we need to sometimes pretend to ourselves that we are going to follow, but we are not going to leave it initially like we did in the hands that we initially put ourselves in. We're going to come up with other ideas, other rules, and get rid of some of these bumps, even though at one point we felt like the bumps were just part of a very successful strategy. So that's what I'm kind of against, is what I call systematized discretion, is just write a rule for it. Like when I sit in front of my computer, I can remember sitting in front of my quote machine and being long coffee in 1988. And I probably just got out of some of it because I was afraid, or I didn't want to lose the profit. Just started my company. And no one would say that was a good idea. You weren't disciplined, you didn't follow your system, and that's what you have to do. True, I agree with that. And I don't think there's much difference if I had have said, I have this issue and I want to create a rule that I can say, I'm following a rule. And the rule does the exact same thing. Low sample size, get out of a big trade, come up with some math reason, some rule-based reason to get out of it. Then I can say, well, you can't fault me for that. I followed my rule. So, no. It's just systematized, rules-based discretion. Okay. That's all I have. Anybody else going to pick up?
Yeah, I would pick up on that. It's the sample size issue again. We have a really hard time finding a system that has enough sample size for us to trust. And then when it starts going bad, what's the sample size we have to say that it's not working anymore, it will not work into the future? It's even harder to answer this question because the sample for that is non-existent. We don't have a sample for the future. And that's why it's uttermost important to have simple rules in which we can trust. comes again the issue of trust you just mentioned, Jerry. And if we find a system that we start to suspect it's not working anymore, we should ask ourselves first why we thought it was a good system in the first place. If you have simple enough rules, you have a sample in which you can trust. Otherwise, you won't. I'm in this trend following thing for a much shorter time than most of you guys here, definitely. But I simply cannot think of a process to retire a system. I think it's a continuous search for a better system, and that's it. That's the thing. I can't think of a way to retire a system and say, yeah, this is not working anymore. Let's change it completely, revamp everything. It's a process of getting better and better continuously.
Yeah, I agree. I tend to look at, have there been any big trends? So I'm relying upon, I don't know if it's 5%, 10%, 1%, but it's a small number of trends. I think it's important just to use percentage so you remember that. I've listened to podcasts where people would say it's 10 trends per year or 5 big outliers per year. And I'm like, it's not 5, it's not 10, it's 5%, it's 10%. It's some sort of percent. You're not good enough to choose all the best markets. You're not bad enough to add markets in over a medium time period, add just the wrong ones that are going to dilute and hurt your performance. Oh yeah, so I looked to see where are my opportunities. Obviously, I didn't miss any of them. I got in all of them at the breakout, and then did I get bounced out? Did I keep getting bounced out? The market went on a 1 or 2 year trend, and I just kind of missed it because I was trading too short term. And at some point in time, your long term exits will be too short term because the markets will be so choppy, and so you can't trade the 1,000-day breakout, can you? And so, but if you're in the trend, you didn't get out, you don't keep getting bounced out, so you're pretty sure that this recent performance is not lack of performance is not due to being too short term. And then, of course, when the trend ends, did you give back too much? And it all is a problem with sample size because it's only 1 year, or one group of trades, and yeah, it's a problem. I think you just do what you can do, and what I can do, given the past 10 years, is what I've done, and that is go out, find more diversification, which I've added a lot of commodities. I added a tremendous amount of currencies. I've added every bond future available and many, many interest rate ETFs, crazy ETFs that are interest rate related. And then I went out and expanded my universe of equities to the degree that they offered true diversification and made the portfolio more diverse. And so what are they going to come at me with next? I don't know, but I'm doing all I can to avoid a repeat of the lost decade when stocks were the only thing trending, but I don't want to be a stock trader because of all the benefit of shorts and the other markets.
I mean, just a follow up on this. During this CTA winter, of course, the single name stocks have done great. And what I'm thinking is, I think we've discussed the fact that we risk differently for different markets at times, and our asset class allocations could be a little bit more flexible. So instead of 25% each, depending on whether the equities are in bull market, maybe we could allocate a little bit more to equities during bull markets because there is a data proven long bias. I mean, it just makes sense to me to break that. When equities are going one direction, historically there has been many times where the data supports this, and because not many traders trade single name stocks, it's just such an uncharted territory at the moment. But it just doesn't make sense, just to allocate 25%, or just to keep it fixed for your entire career and do not change it. Okay, if you do that, well, you're definitely losing a lot when the equities are going one direction. Thanks.
Well, I mean, I think that most people, there's not many people who maybe trend follow stocks. Not many CTA types. I think there are a lot of people who trend follow stocks, but we're kind of the experts in trend following. So, how expert are they? It's really important to take the trend following approach with that the CTAs have, with all the proper necessary structure and rules and processes and 10 commandments of trend following, and apply those to stocks. And I think people, that's very worthwhile. And they're applying them to stock indexes, lots of them, long and short, that have very little chance of having an outlier move. And I'd like to have someone get into this long debate with me about this, because usually no one's going to say anything. No one ever has. And that is, how is it legitimate, come up with a better word, to trade a conglomeration of markets where if you traded them individually, some would be long, some would be short. You'd size them based upon themselves, not the group. Why? How can that be kind of legit trading to trend follow a stock index? But there will never be any skepticism of trend following stock indices. No. However, I don't know. Does trading single stocks work with trend following? I don't even know if that works. It probably doesn't even work. But somehow you add them all together. It's a joke. And of course that works, because that's what we do, and that's what the clients want us to do. Oh, there's another thing afoot too, where you torpedo your own portfolio and your own performance. You reduce your performance by acquiescing to the client's desire to limit your equity exposure. You're on this planet to work for me. If it screws your track record, makes you less money, makes you less attractive, so be it. You're here to serve me and my dysfunctional long-only portfolio. I don't need you to give me more long equity exposure. So I remember coming out of a total program, and it was just more along the lines of you do the hard thing, do the right thing. Trading is hard. People are going to try to convince you to not follow the rules, get out of profits quicker, not take small losses, not diversify. And so clients are going to be kind of problematic. They're just going to be a little problematic. And true. I mean, we had our original client taught us how to trade, super genius, gave us his own money. When we had big drawdowns, gave us more money of his to trade. Total pretend environment. Growing up trading in that environment is so beneficial, not just the rules, but tremendous positive feedback for doing the right things, following the rules. But people came out of there with a little chip on their shoulder as it relates to be skeptical of these clients. Oh my God, how things have changed. Skeptical. The clients are worse than ever. They're overstepping, way worse. And there's nothing that people won't do to get their money. Nothing.
Jerry, the more I've been listening to these podcasts with Niels, and the more I'm sort of hearing the different program managers discuss how they view trend, etc., the more I'm thinking to myself that we probably really need to reposition ourselves as a particular class of trend follower, like an outlier hunter, which is distinguishing ourselves from a lot of other different types of trend follower, because we're getting into these massive debates simply because we're dealing in a world of outliers, non-linearity, and it causes a lot of confusion with other traders or investors who aren't trading that particular form of price. And the more I think about it, the more it helps us if we do sort of segregate ourselves away from the balance of trend followers. What do you think?
Oh, I agree totally. For many years, I was complaining about the term managed futures. We should adopt trend following, CTA trend following. CTA is such a wonderful term. It has a characteristic that a lot of good names have, and that is it's totally irrelevant, but everyone knows what it is. And it's easy to research if you don't. If you're living under a rock, okay. But yeah, and so it's a beautiful name with a tremendous history and legacy, um, and people know exactly what's going on when they say CTA. Um, but then I realized that no, I should not ask for managed futures, the term managed futures, to go away. I should continue to make that distinction, which is there's managed futures CTAs, um, and then there are CTA trend following. And there, you and I talked about how we used to add classic trend following to it, and that got negative reviews, and we were made fun of. So, yeah, I think I'm glad that I stopped myself, and I, I think that we do need to continue to make these distinctions. A lot of the things I tweeted about this yesterday a few times, and this is a little bit off the subject, but I think a lot of the arguments or discussions we have is people talk past each other and they don't remember what they've heard a million times. And one of the these claims about what the back test shows and what works, what doesn't work, it really is dependent sometimes just on, are you using Sharp, or are you using volatility, or we don't have a really good way of describing and shortcutting how we look at risk. Um, the advantage of volatility and Sharp and things like this is it can be grabbed from the performance table. Just look at the most cursory review of someone's performance and you can calculate their risk as if it was that simple. Well, they want it to be that simple, so it is that simple. That's what we have, that's what we're going to use. So deal with it. And so we're like, no, we need to dig a bit deeper and to see exactly what is real risk. These formulas need to translate into risk of ruin better, into the possibility of losing money and a fatal amount of money and true risk. And the way we set it up with our trade level, small losses and our mini markets and letting profits run and protecting capital, our definition of capital, we really get we don't get the proper credit for all of those algorithms that put us in a really good place as it relates to risk, even though it looks pretty normal, average, or below average if you look at the performance table.
Yeah, just that comment from Graham Capital, where he talks about the risk-adjusted returns being related to the square root of n. Like a comment like that is clearly from someone who isn't trading outliers. So, the assumptions embedded in the square root of n is that each return stream delivers the same expected return, and so therefore we can apply the square root of n as a principle to sort of determine where there's no further benefit from sort of further diversification, because it sort of tapers off and there's a sort of marginal limit. But, in dealing with outliers, of course, we understand that these markets, which typically get excluded from that term, have the ability to deliver these spectacular anomalies, which totally sort of dispute that claim. So, that's why I think that a lot of these programs, they're not doing what we're doing. And I think it causes a lot of confusion with people when we classify ourselves as trend followers. They all assume we're doing the same thing. And I don't think that's helpful to our cause at all.
They think we're inferior. And I just get the impression sometimes that it really makes them mad and angry that we're challenging this. And I think they can completely understand sometimes, and they just choose to be so mad and negative. I remember many years ago, I was on the phone with this potential client, and I was asking him. He knew about futures and CTAs. He worked for a big bank, and he was like, "Well, tell me how you trade." And I'm like, "Well, we use trend and breakouts and diversification, small losses, let profits run." And he was like, "Yeah, okay, I like that. That sounds good." And I said, "Well, another thing that we're much different is that we trade single stocks and not indices, or not just indices, but single stocks as well." "Well, how do you trade those?" "Well, the same way, exact same way. Ignore everything except price, trend, uh, diversification, small losses, let profits run." He was so mad at me. He got so angry that how dare I step into his world with this silly trend. And I think some of these guys get so angry at us and so mad. It's settled. This is settled finance. It's settled portfolio management. And then, but it's not. And I'm telling you, it's not settled. And oh yeah. And so they got, this one guy, I think it was very rude. I asked my friends, was this rude? Is this guy being rude to me? I think he is rude. I think he is rude to me. And anyways, but he said that, I don't know if you saw this one, but I commented on it. And it was like, he said I was just religious. This is a stupid argument from religious traditional.
Epsilon.
Okay, dude, whatever. So, and then another response late last night during wine drinking was not my best work, obviously, but was this idea that, oh, you have religion, dude, come on. You just choose your religion. You accuse me of having one, okay, whatever. But you got to choose who you're going to worship, who you're going to follow. Um, so it's really fun and frustrating at the same time.
Jerry, you said what is real risk a few minutes ago, which I think is just a very interesting question or comment, because I think in most of the finance world, it's viewed as volatility, right? If you go to modern portfolio theory or the Sharpe ratio, risk is volatility. But I would say it's really drawdowns, because that's what gets people to abandon good strategies when they hit too big of a drawdown. And when you take that view that drawdown is the real risk, I think MAR ratio, which is your compound annual growth rate divided by your max drawdown, becomes one of the better ways to measure managers. And when you use that and you compare like a lot of guys over time, you find trend followers have the best MAR ratios by a pretty wide margin. And that's against almost everybody, even like Warren Buffett will go down 50, 60% at times. So I welcome your thoughts on that, but I've been just thinking a lot about drawdowns as opposed to volatility as real risk.
Yeah, I really can't argue against drawdown for sure. Part of those ratios, is the numerator. So we're pretty good at that part as well. With all the markets we trade, long and short, following price, using rules. If you don't have all of those things going for you, you're going to be at kind of a disadvantage. And on the drawdown side as well, how good would you have to be to have a profile of a good CTA trend follower who trades all these different markets and sectors? if you only trade equities. I mean, that'd be very difficult to do, right? I mean, how that would be an amazing person. It would have to be something really, maybe short-term Renaissance type people, and they're out there, and they do this. But for most of us, we just have such a huge advantage. Yeah, I think for me, it's like how much I want to push it as much as I can, and I'm comfortable with, and I don't want to have a risk of losing money that would make me have to stop trading. Not because I don't embrace, like you do. You threw in there this thing, I think, of the drawdown, and then your big problem with this drawdown was something like you'll stop using the system. So I want to separate my feelings and my human shortcomings and failings, because you can always blame some sort of drawdown, even though it doesn't sound objective to me. Oh, I couldn't keep using it. I'd rather just stick with the spreadsheet and the Excel and the math of it, and just assume that I'm going to make this rational decision, not an emotional decision. So I think that the way we do it, we bifurcate the open trade equity and the closed trade equity, the capital. And we define that as the capital, the realized profits and losses, and the initial capital contribution. And so we just don't see the way we trade with massive drawdowns in open trade equity, massive open profits with big drawdowns. It just doesn't impact our capital. So I think in some respects that drawdown can give off a false signal and make you trade too small or not get as many investors, because really we're the best at preserving capital. And then people say, well, I don't agree with that definition of capital. It really bothers me to have these drawdowns, even if they are, you were up 100%, now you're only up 50%. You're the best performing person in my portfolio, but you've had a 50% drawdown. Okay, so that's where we can't, it's difficult for me to agree, I think, with Mar.
I get what you're saying about, let them run and they have to come back. But I mean, if I'm looking at ISG and I'm looking at Chesapeake's diversified program, and your max drawdown over 30 some years is basically 30%, and your compound, according to this, is 10. So it's a MAR ratio of about 0.3, which is better than pretty much everything out there. But I guess, to me, it's like if you could convince the world that, well, to your point about emotions, I think that's how a lot of people decide they're going to get out of an investment, for better or worse, right or wrong. People say, oh, I'm down 20, I'm down 30, I'm down 40, I can't take it, I abandon ship. So if you can manage those drawdowns in aggregate, you could keep people. And if you say, hey, that's risk, the risk is that you're going to get too emotionally upset, you're going to abandon ship, then you could say the MAR ratio is a good way to go. And I get your point, like within the strategy, you don't want to say, hey, bonds went up a bunch, I'm going to get out just to manage my drawdown. But clearly, in aggregate, across your diversified program, you are managing drawdowns better than pretty much anybody. So I don't know if that helps to clarify what I meant.
Yeah, I agree with you, George. I think that in our world of outliers, we deal with extremes. So I do like MAR ratio because it's dealing with the extreme point of the drawdown, and it's also dealing with our beneficial uplift with our KGAR. So I really like that. But I think, in Sharp world, where they're dealing with linearity, they often miss the hidden risk that lies within their return stream. So you get this amazing Sharp for a period of time, but it's hiding the negative skew that lurks there. And you find that, over a long enough time horizon, suddenly this magnificent performing strategy with very low volatility, high Sharp, deteriorates into risk of ruin. And I think Nigel Kalajian from Quest put it very suctically. He said there's an incredibly high correlation between a high Sharpe ratio and risk of ruin, and I totally agree with that. We saw it with LTCM. So something that I think we need a path-dependent metric that's definitely better than, say, Sharpe, which is not path-dependent. So we need to recognise that over the course of the investment horizon, we need to note the path, and we need to note the extremes of that path, particularly when we're dealing with non-linear regimes. So but, you know, MAR in itself, like, I suppose a superior metric to that would be how quickly do we recover from drawdowns? So, you know, if you get a program with a high Sharpe and you find it suddenly gets into a negative skew event where they get a massive, quick, accelerating drawdown, it often takes years and years and years for them to recover from that. But because we're attacking non-linearity with these outliers, even though we might get sort of a fairly high level of drawdown, we're quick to bounce back if we latch onto these outliers. It automatically swings our equity curve far higher than the preceding drawdown to a new high watermark very quickly. So that's telling me clearly that volatility is not risk. It's clearly telling me that, you know, the logic of the system is very important. The track record is very important. The ability of your program to survive over multiple regimes, different regimes, is extremely important. But all of those things aren't expressed by the traditional metrics such as Sharpe, Sortino. You know, MAR gets closer. You know, Ulcer Index gets closer, maybe Serenity Ratio, but, you know, they're all proxies. And I think the long-term track record is probably the best proxy we've got at all for, you know, how a program fares with risk events.
So true. You know, I've asked these questions before, like, would you care about drawdown and volatility if you had a system that never had any losing trades? And people don't want to answer that question. They refuse to answer because they make up stuff. Well, it doesn't sound like it's robust. Come on, it's just a little funny question, you know. If you had a system with no losers, and eventually they were all going to make money, would you care about vol and drawdown? And the answer, of course, is no. But they don't want to admit or answer because they don't. Their assumption relies upon the fact that there are not these exceptions to these things that they believe in. You cannot ever prove them. There's no situation where they'll sound silly, and there are. But it's like if you agree with that hypothetical, then the whole game is over. Well, it's over. Okay, so and oh yeah, I can't think of my third example, but my second example was if you have a drawdown of 5% from your initial capital, is that better or worse than a 50% drawdown, but you're up 20% still? And all drawdowns are not equal. No, and this is another thing that is missed, that they are treated as all being equal, irrespective of how much money the client still has. And no normal person walking around on the street would agree with the with one of the assumptions is that it doesn't matter how much you've made recently. It doesn't matter if you have open profit. If the investment's tremendously profitable, the drawdown is the drawdown. So I think it's difficult to speak coherently in the real world and hold some of these views about drawdowns. I think my favorite has always been the trend following, the longer term trend following with lots of markets. It consistently makes money almost every year. And my first 7 or 8 years, we made money every year. And I don't think people were too concerned about my volatility or drawdown. They were greedy. They wanted that money. It was reliable. I like the metric of how many of the trailing 12-month returns are positive. I think it's very high for what we do. And my friend Mike did a back test of one of our systems. I've told the story a million times. Last year, and back to 1977. Now, granted, there's a lot of exceptions to this, like the number of markets, and it was adding markets, and how do you handle that? But I asked him, what were your results going back to 1977 through 2020 or 2021? What was your results of that? Our system, I think it's system one. And he goes, it never had a losing year. Now, of course, it had some 0.5% winning years. And regardless, just different assumptions could have turned some of them negative, right? But it was not going to go to 90%. No, no. I'm just telling you, that's the deal. And now what happens with 300 markets? More diversification than we've ever had before, right? So it's a pretty darn good strategy. And you can kind of see why, because I'm in the inside and I know and I've seen this research and I know what it's like to put together a good system. You can see why my tolerance for negative skew and crap that overall only helps you lose money, that produces less of a return in exchange for, yes, it will help you out when trend following does poorly. Come on. What other industry, what other segment of hedge funds is not only asked to do this, but the managers love to do it. They love to do it. And I could be cynical and say, yeah, they do it because trend only is 100 basis points, and trend, which is driving all their returns, plus all the other crap they put in there, that's probably still 2 and 20 for some of them.
I think also it's very interesting to hear all this. And I think that Sharpe ratio is not the best measurement, I'm sure, because and it can high Sharpe. I agree that it can show hidden risk, big hidden risk. If it's too smooth, it's too good. And investors, yes, also usually very often they want only money on their account and nothing else. And all the else is our job, I understand. But they are not thinking about the process. They think about only performance, and when they see drawdowns, they think that it's a losing game or something like that, and it makes them a big issue. It makes them not being a consistent, and all the processes, as I know, all the processes requires consistency, not only in trading, in business and many other things. And so the investors see a drawdown in a trader's account, and they go to another trader who is in profit now. And when he has a drawdown, they go to another trader, and so on and so forth. And at the end of the day, if these all traders will be in a profit, good traders, after these drawdowns, the investors will lose their money because they invest in the high of the strategy and take their money in a drawdowns, and I have seen this. I have seen this many times.
What do you think, George?
I was thinking about I'm not sure I got it quite right, but I guess I'll call it a thought exercise, but you had said, like, what if you could say, hey, would you care about volatility or drawdown if you knew that you were going to make money? And so just to clarify, like, were you basically saying to people, hey, look, if you know that every realized trade is going to be a profit, but you might get an unrealized loss in between, would you care about volatility? Is that kind of the thought behind what you were saying?
Well, except for the loss part, I just want to establish, we can be honest with each other. I just want to establish, is there any scenario where you would say, oh, okay, into that scenario, obviously, if I knew it was going to be a winning trade, if, for instance, that famous guy who shorted the mortgage backs and made all that money,
Jerry Paulson?
Yeah, right. So Paulson, so he makes all this money and he has this inside info that this trade is going to be a winner. And so before it really gets going, or as it gets going, it has a big, he starts losing money or losing some open trade profit, and so he is not going to get out of that thing. He knows what's going to happen. We know what's going to happen based upon data as well. I just wanted to establish, is there any scenario? And basically, yes, of course, there are some scenarios where I still am always going to prefer drawdown or vol, Jerry. You're not going to convince me not to prefer it. But in your fantasy land, of course. And it's a gauge of I guess religion, I mean, because this is true religion and emotion, and it's not math. If you draw up a totally reasonable solution to put one little chink in the armor, that this thing of always looking at vol and drawdown is not perfect, will you acknowledge that? No, they won't acknowledge it. This is who you're dealing with. So it's a personality test. Like, are you going to subject yourself to reality and math and numbers or are you going to have zero tolerance? And I think there's just too much zero tolerance out there.
Thanks for clarifying. No, it's an interesting thought exercise, or personality test, I guess I should call it now. But another thought that kind of stems from what we've been talking about is just, it seems like we all essentially agree that volatility should not be risk. It is not risk. And, I guess that leaves what is risk. And I think it'd be an interesting exercise as a group to try to come up with a definition of, what could you consider risk if it isn't volatility? And I don't expect that to happen today, but maybe something for future calls. I welcome your thoughts.
Well, we have a friend who doesn't show up on Spaces much anymore, and I really miss him. And it's the other Bruno, and I gave this big long diatribe about volatility and stuff, and how it's not risk. And then right after that, he proceeded to say that volatility is a great measure of risk. And I was like, oh, wait, I really like Bruno. And I need to think how we both can be true. I just got finished saying that it wasn't, and he just got finished saying that it was. So I said, okay, Bruno, I got a question for you, because I just finished saying that it wasn't, and you just got finished saying that it was. So rather than getting mad, I just said, we're both right. How can we both be right? And I thought, oh, wait a second, Bruno, are we both right because I'm right because I use closed trade equity as my trade level? He goes, yes, you're right because you use closed trade equity. Brilliant. You have unshackled yourself from traditional measurements of volatility equaling risk, and you're in another category. And I was like, okay, cool. So I think that the way we size the positions using a closed trade equity, an equity level that can be way less than AUM, really changes the dynamics. And you trying to explain that is almost impossible. That's just crazy. But it's under the philosophy, which I remember listening to this philosophy in the Turtle class. And there's this thing I think called beginner's mind. So like the dumber you are, the more accepting you can be, and you're not being held back by what you know or you came in knowing. And I think that, but it wasn't like I was naive and dumb, but I just thought this was one of the greatest things I'd ever heard, because the philosophy was, when you're making money, be slow to increase that trade level. It's just like being conservative. Be very slow to say, hey, now this is my new trade level, because some of those profits can be open and go away. And you're sizing new trades based upon this elevated equity that now is no longer there. You can see how that can kind of spin out of control. So as a money management scheme, we want to stay in the game, and we want to play this edge out for the rest of our life. And then as you lose money, however, be very quick to scale back your trade level. So you're quick on the downside, slow on the upside. I mean, I thought this was brilliant. And I just embraced it wholeheartedly. It made total sense to me. We were trading short term. We were making 200% a year. It was a whole different game. But I think that in some respects that it's still applicable to long-term trend following. And I just bought it hook, line, and sinker. It's just one of those things when you hear it, you're like, yeah, that's correct. Oh, you try to sell that on Twitter. Whoa, that's a tough sell.
I must admit, I'm pretty clear on what risk is, George. So the way I view it, and Jerry's been talking about this, is that I view risk as a permanent loss in trading capital. In other words, this realized balance is the critical thing for me, because I'm using my unrealized equity to hit the ball out of the park. So, I'm not worried about the trades that are still alive, that are still yet to be decided how they play out. I'm always worried about all of my closed trade equity or my realized balance at any particular time. That's what I'm defending. Any loss in that I regard as a risk event. So the way I view risk is it's comprising two components. It's comprising the traditional way a lot of managers see risk, as in volatility about a standard deviation around an expected return. That's what I regard as a risk associated with a back test. In other words, undertaking a back test, you can determine the expected return and the volatility around that. And then you get your traditional measures such as Sharpe, Sortino, all of these things associated with that expected level of return. But a trend follower like me says, hold on, that's a very limited view of risk. What about the risk associated with uncertainty? You're just giving me the risk associated with certainty. In other words, the risk associated with your back test or your historical data you've developed your volatility measure over. That's a known risk from historic volatility. I'm saying, what about uncertainty? That brings a new level of risk or a new layer of risk that is typically excluded from a risk manager's perspective, because they don't know how to measure uncertainty. There might be a confidence interval associated with it, but what is that true measure? So that's where we come back to this realized balance. If we're protecting our realized balance at all times, we are defending that clearly, and then with our unrealized equity, those open trades that are well above that level of realized balance, we're trying to hit the ball out of the park to totally, lift and skew our equity curve to the positive beneficial side, and that's not measured by Sharpe. So any beneficial volatility is penalized by Sharpe. We say, no, Sharpe's the wrong measure. MAR might be a better measure, but really, what is the risk of certainty and the risk associated with uncertainty? That is really a better capturing of risk, because so many traditional programs out there just look at this risk of certainty, and it hides what we call the warehouse risk that's hidden within that program. And that warehouse risk might be associated with techniques they've used to mitigate risk or push it across different areas of the portfolio, or a way to hide risk. But as we know, risk cannot be you can only release a risk event through a trade exit. Shuffling risk around your portfolio is not a way to remove risk. It's just a way to transfer risk. And there lies a problem of what we call warehouse risk that is not measured by these traditional metrics. So that warehouse risk shows up as uncertainty in those expected returns of certainty that they're developing their risk metrics about. So we view risk as a far wider measure than what maybe a traditional program might view risk, as in the volatility around it with an expected return, etc.
I agree with everything Richard said. I mean, I think it's difficult for people to look at this as, I'm going to risk one and make two, I'm going to risk one and make three, like they're sitting at a blackjack table, and ignore, that they've made a lot of money, but ignore the fact that they had a lot more. At 12 p.m., I had a lot more than at 3 p.m., but still, I'm really concerned about that. I think it's hard to just turn your back. You want to make it better. And the way to make it better is to not have these drawdowns, but then trying to get rid of those drawdowns may have a massive negative impact on your overall profit. The whole definition of what we do, take small losses and let profits run, it's a cliche. And if it didn't work, we wouldn't do it. But it is a good starting point of something to test and research. And if it does work, I mean, paying attention to closed trade equity is so, and separating these two out is the same thing that we're doing on the trades. We're separating the winners from the losers. So we look at this closed trade equity. We want to protect it. We want to take small losses. We want to have that finance our open trade equity. We're going to let those profits run. And so all these open profits, the open trade equity, we're going to treat that differently, just like we're treating the winners and losers differently. So to us, it just makes perfect sense. People complain all the time. They have this one great comeback. Never heard it before. I'll get him on this one. There's no answer for this. And that is, you're not paying attention to the open trade profits. I care about those. Those are mine for the taking. Why don't you care? Why are you just like not paying any attention to them? They're ours. You cannot ignore them. And I'm like, oh, far from it. I'm handling the open trades better than anyone. I'm handling them. You cannot handle them better than I'm handling them because I'm doing what the computer told me to do. Let those profits run. Don't get out until your trend following trailing stop is hit. That's how you're going to make the most amount of money. That's what I do. How could they be handled any better? It's just ironic that in order to get that money, in order to maximize your profit, you have to put your faith in those exits and follow those exits, knowing full well that at some point in time, that faith will not be rewarded on certain trades. You will have done better by overriding on certain trades, but you will not have done better when you look at the performance of all the trades.
It's interesting. I mean, I was thinking about a different level of risk, which I'll explain, but just hearing you guys talk, it's like there's trade level risk, there's, trend following strategy level risk, and then there's allocator risk, which is more what I was thinking about. You talked earlier about religion, and I think that, real religion, most people adopt the religion of their parents because that's what they were born with, right? And similarly, this modern portfolio theory and this conception of volatility as risk is just something that we all say, hey, that's what it is because that's what we learned in, I think it was the 1950s, but that is a very strong driver of allocator level risk decisions. And I think my kind of end goal or thought in even discussing this is that we all think trend is great. We may argue about specific nuances, vol targeting, etc. But at a high level, I think it's kind of like sometimes a bit mind-boggling as to why the world doesn't see it the way we see it and say we should be allocating more money to this. I mean, I think trend as a percentage of hedge fund assets in aggregate is something like 10%, which it seems like it should be more. But so with that, I guess what I was more thinking about is like the allocators that I've talked to and known, they really do look at the sharps and the volatilities. And so how do you get them away from that conception and to a different conception of risk that makes them see that, hey, trend is really valuable? And maybe it's not possible, but just to clarify, that's kind of more what I was thinking about as opposed to like open trade equity on a specific position.
I think it's very hard, George. I think that really the religion you're talking about there has been the religion associated with the efficient market hypothesis. Then comes Sharpe, then comes modern portfolio theory. They're all related concepts. It's a traditional way that was used by industry to deal with risk. And I think that the things that are challenging it now is, schools of thought such as complexity theory, the Santa Fe Institute, these things, in dealing with complexity, which is how we view trends as being part of a complex adaptive system, these non-linear features. It's a very complicated landscape, and it's something that defeats the simple traditional models that have tried to deal with these landscapes. So I think it's an educational exercise that slowly over the course of time, people are going to get a better appreciation of how complex adaptive systems work, non-stationarity, all of these things, which are sort of typically shunned by the traditional statistical schools of thought that deal with things with linear measures in a non-linear world. So, it's hopefully it's something that education over the course of time improves. But I think allocators are in the game of satisfying their clients' demands, and the investors' demands are totally different to the program managers themselves. So most program managers have to dial down their programs to meet the investor demands. But as Marty Luke said in his interview with Niels the other day from Aspect Capital, he said trend following is the medicine we all need, whether we like it or not. And I think that's unfortunately what we're dealing with here. We recognise it's the medicine we do need, and we really love that medicine we get. But unfortunately, investor appetites shun that because they're not getting immediate gratification. And there's these drawdowns and things like that that people hate. They want immediate gratification and the smooth, linear ascending equity curve at all times.
Well, I just have to weigh in on that. I don't really, Richard and I disagree on this, but I don't hold out any hope for education. No, I'm not going to educate. No, they're going to be forced and beat over the head and hate it all the way, and they're going to be forced to do it. They're not going to be educated into it. They have to be defeated. So, no education. And I did not enjoy, my least enjoyable so far of the Top Traders Unplugged is who he just mentioned, Marty from Aspect. Yeah, no, my least enjoyable. Because he's very, he's the best of them all at fooling, people. And so, yes, he did say that. However, his point was not that trend following was this amazingly good, tough medicine. No, he set up his other point, which is this is the reason we don't trade pure trend. Trend is so hard and so ridiculous and so terrible for people. The other guy from Lynx, he was like having a breakdown about how hard the drawdowns are on him. It was like crazy. And so, no, Marty was not talking about how much he loved trend. He was setting the stage for this is why we add a lot of stuff to trend to water it down, because it's this medicine that no one can take. Oh my God. Okay. So here's the problem. The problem is that the best and biggest managed futures firms with the smartest people and the best infrastructure don't trade stocks, and they don't pursue the strategy of trend following and diversification as the perfect portfolio that someday they could present to people when they're ready, when performance dictates it, because that's what it would take, is just outperformance. When we're in the business to begin with, and for the next 15 years or so, every time we would present to clients, we could show that not only did we make more money than the S&P, but we had less volatility and risk. So those days will return. They're destined to return because we have a better process and we have more diversification. But they're not ready. They won't be ready because they don't want to trade equities. They don't want to improve the portfolio. They don't want to trade the best systems possible because that's not what's best for crisis alpha. So you've got the leaders of the industry continuing to produce a product that keeps the AUM at high levels, the current people happy, and there's no innovation to where the world's going to go. If the world is going to seek out and see the benefit of trend for equities and bonds and not a 5% allocation to CTA. So until that changes, and you're not going to be taken seriously in the investment world if you don't embrace trading stocks with your trend following. And then I think about the Campbell guy does not trade stocks in the CTA portfolio, But in other portfolios, he said we trade 5,000 stocks. So so it's a mess. I'm not sure what's going to happen, but then the best product available from the best people available is not on the market. Richard, one final word.
You had me laughing, Jerry. I agree. Trend following is the hardest game in town. There's no question about it. But that's what drives us, and that's what gives the edge. So, yeah, I totally agree with you.
Okay, great. All right, it's been fun. I'm sorry for the technical issues I think we experienced an hour ago. They may have gone away, but I'm sorry for people who didn't get a chance and couldn't hear others and couldn't hear me. So anyways, it's been fun and great 2 hours together, and we will do it again next week. I'm pretty sure. I have some travel coming up, but I'll let you know. Let me know if Saturdays are bad or Sundays are bad. Same time, but I think I have some Fridays that's going to be difficult for me to make next month. Anyways, have a good weekend, everyone, and thank you for being here.